Finance Core, Topic 6, Capital Budgeting and Evaluating Corporate Investments. Readings include Chapters 8 and 9 in Core Principles. Learning objective number 1, we're going to understand the capital budgeting process and valuation principles. So the capital budget is an annual process of selecting the capital investments to fund that increase firm value. All positive NPVs increase firm value. However, organizations often have a fixed capital budget, so a fixed amount they're going to spend. With this capital budgeting constraint, value is maximized by selecting the set of investments with the highest NPV. Significant operational expenditures, or OPEX, may also be included in this process. Let's talk about the principles for valuing these projects. One is you want to use after-tax cash flows, not accounting income. We want to use market values, not book values, except when used to simply calculate taxes. And we want to use unlevered cash flows, which excludes debt and interest. The effects of financing is reflected in a discount rate, and we're going to talk about that in the next topic. So we're going to focus on trying to calculate the unlevered free cash flows, the FCFF, free cash flows to the firm. And that would be your after-tax EBIT, add back depreciation because that's a non-cash expense, subtract the CapEx, add back any salvage from that CapEx, and subtract changes in net working capital. You want to make sure we only consider the incremental cash flows. So I don't want to include any sunk costs, costs I've already spent, or any allocated costs if they're not incremental. So for example, the allocated expenses for, say, the existing salary of the executive team. And we do include opportunity costs, any foregone opportunities from selecting this investment. We want to include any synergies or add-on sales to an existing business. So say you launch a business and increase the sales in another part of the business, you want to include that. However, we do want to include the sales losses from cannibalized sales. So a launching of a business line reduces sales in another area. You want to include that other area's lost cash flows. We want to also include the incremental working capital needs. That would be the receivables minus payables, any inventory buildup and reduction at the end, and any cash needed for operations. And lastly, you want to make sure we include taxes or tax shields on our expenses. We'll talk more about tax shields later. So those are the valuation principles and the idea of what the capital budgeting is. In the next topic, we'll look at all different types of projects, including revenue and cost projects and cost-only projects, and we'll talk about how we evaluate those investments.